Good day, everyone, especially to our fellow learners. Today, I'm going to present the second lesson from the book FEMA 3083 entitled Introduction to Capital Market. To help us understand and gain knowledge about this topic, let us welcome Ms. Princess T. De Castro, a BSBA student in Christ the King College de Miranding. Today, we're diving into an essential topic in the world of finance, the capital market. So let's get started.
A capital market is a financial market where long-term debt or equity-backed securities are bought and sold. The capital market plays a crucial role in the economic development of a country. Capital markets raise long-term funds by issuing stocks and bonds, financing business expansion and infrastructure projects. They provide a platform for investors to easily buy and sell securities, ensuring liquidity, which boosts investor confidence. Capital markets help determine the fair market value of securities through the interactions of buyers and sellers. Investors can trade securities to manage risk, and instruments like derivatives allow hedging against potential losses. Capital markets direct funds to the most promising investment opportunities, promoting economic growth and innovation. The capital market is broadly structured into two main components: the primary market and the secondary market, each serving a distinct purpose. The primary market is where new securities are issued for the first time, allowing companies and governments to raise fresh capital directly. Key processes in the primary market include initial public offering, bond issuance, and private placement. In the secondary market, previously issued securities are bought and sold among investors, providing liquidity and continuous pricing. The secondary market includes segments like stock exchanges and over-the-counter trading, ensuring efficient transactions. Together, these components ensure a well-functioning capital market system, supporting economic development and efficient resource allocation. The capital market offers a variety of financial instruments for long-term investment opportunities, broadly classified into equity securities, debt securities, and hybrid instruments. Equity securities represent ownership in a company. Shareholders are partial owners of the issuing company. Common shares offer voting rights and dividends. Preferred shares provide fixed dividends and priority during liquidation, but usually lack voting rights. Equity securities have the potential for capital appreciation, dividends, and carry higher risk compared to debt instruments. Debt securities represent a loan made by an investor to the issuer, ensuring regular interest payments and principal repayment at maturity. Bonds, debentures, and government securities are types of debt securities that provide fixed income and lower risk than equities. Key features of debt securities include fixed income, lower risk, and priority in case of liquidation, but no ownership rights. Hybrid instruments combine features of both equity and debt securities, offering a balance between risk and return. Convertible bonds, preference shares, and warrants are types of hybrid instruments that attract a broad investor base. Hybrid instruments provide a flexible risk-return profile, appealing to those seeking both income and growth potential. Each capital market instrument serves different investment needs: equity for growth, debt for steady income, and hybrid for a balanced option. The capital market involves a range of participants, each playing a vital role in its functioning and development. Entities that raise funds by issuing securities include corporations, governments, and other institutions. Issuers raise long-term capital to finance operations, projects, and expansions. They issue shares, bonds, and other instruments to attract investors and disclose financial information. Investors include individuals, institutions, and foreign investors who buy securities. Investors provide capital by purchasing equity or debt instruments and help in price discovery. Intermediaries are financial institutions and professionals that facilitate transactions between issuers and investors. They ensure smooth issuance and trading of securities, providing advice and research to both investors and issuers. The capital market mobilizes savings, facilitating the raising of long-term funds for industrial development. It provides financing for businesses to expand operations, increase productivity, create jobs, and ensures market liquidity. Capital markets risk management tools help hedge risks and diversify investment portfolios. Thanks for watching my learning review. I hope this helped you understand the connection between credit ratings and the bond market.